Hi, welcome to the Oak Trader Report. This was put together on the 9th. Most of the charts were put together on the 10th American time and the 11th Hong Kong time. It's just coming up to 5 in the morning Hong Kong time on the 11th, and it's just coming up to 4 in the afternoon in New York. I just wanted to cover a couple of Australian stocks, the ASN index as well, and a few American indices that I believe are quite important to look at to give us a clue where the market may be heading in the near to short term. And also I just wanted to broach the subject of Jesse Livermore and his mindset in 1929. Okay, the first chart, I'll just move on to it. Ticker symbol ASX.AX, which is a listed Australian company. I just wanted to show you this first. Where my mouse is here back in 2000, you draw a line down, you can see it clearly breaking upwards. Beautiful consolidation level just above the base, which is a perfect setup formation with a nice little gradual downtrend as here. The breaking of that gradual downtrend with this spike and the continuation of the uptrend, and then the uptrend going parabolic as well. This was a very good trade back in the heyday of the commodity boom, right at the beginning, pretty much following a similar path to copper back in the day. And you can see here it's had a nice and decent shakeout, lost quite a lot of value, and then you see the market coming back up. But you can see this consolidation here. If you compare it to the consolidation back here, this one looks much nicer in terms of a setup, but this does look like it's being set up at some point in the future. But in terms of choices, if I had a choice of a stock that looks similar to this, where my mouse is back in 2000 to 2004, mid 2004, I would choose this any day over a formation or a move that looks like this. And it obviously depends on how much capital you've got to trade. You've got to make sure that the funds that you do have are directed into the best looking pictures. And this is quite a good picture at the moment, but again I wouldn't be trading it simply because it hasn't broken out on the upside. That's one reason, and then the second reason is, as I said, it is a little bit wild here, but it does look okay. But for me, I wouldn't be trading it now. I just really wanted to put this up here to show you a perfect setup, and they don't just happen in America. There's a lot of stock markets around the world where you can trade and put your funds to work in very decent looking formations. You're not just restricted to the American market or the Australian market or the UK market these days. There's plenty of good stock markets, around 10 to 12 liquid stock markets around the world, so there's a lot of stocks to choose from. This was another Australian stock that I traded a long time back, ticker symbol CBA.AX. Just wanted to put it up here just to show you the power of the pivotal point here, the very sharp pivotal point here, the huge bounce back in the market, and very little accumulation here. But on these sharp downward movements, sometimes you can accumulate as much as, say, 6 months to a year of a flatline action. A flatline action makes people sell out because they get bored of it, they get frustrated. That process can take time. The fear process, the technique when you use fear to get people to sell out of their position, can be very beneficial as well for the people, you know, that are looking to push the market up. Quite a big shakeout here, quite a lot of volatility. This move here, where my mouse is in the back end of 2011, shook out a lot of people from their positions. Once they were shaken out, the market then could proceed upwards. And if you draw a line as well from where my mouse is, the early part of 2010, you draw a line straight down, and the perfect time to go long would have been when it had broken out of this particular not so gradual downtrend. The market at the moment, I believe there looks to be a bit of distribution going on here, and I'd be very careful and watchful if you hold Commonwealth Bank of Australia shares. It's had a very decent run up over the last 4 to 5 years. It could have a spike upwards from here. Again, I always wait for the trend line. If you take where my mouse is here and you draw a line up, and you draw a line all the way up, once the time, you know, has been factored in and that trend line has been broken significantly, even if you got out of the position at 65, you know, it keeps you in the market if there is a parabolic spike upwards, but I very much doubt it. But again, sometimes you've just got to let the market give you that opinion. But it does look like there's a little bit of distribution here that's going on, and I would be very cautious if you were long these shares. I just wanted to show you on the weekly that setup we were talking about, early part of 2010, the not so gradual downtrend, and the breaking of the downtrend here with this spike upwards and this move here. And you can see that shakeout on the monthly. It looked more severe because of the parameters, and it's a 5-year weekly chart. It doesn't look as severe, but you can see it clearly breaks the pivotal points, downside, trend followers, you know, a lot of people on the wrong side of the market, and then you can see how there's a little bit of a head and shoulders formation here as well. But it's a great triangle consolidation area at the top of a market, and from these types of moves typically the market may go up 100 to 200%, but they're the types of moves also that I wouldn't hold your hat on them going up 200%. If you do get on the back of one of these, you know, really watch out for the distribution and volatility, and also the breaking of a second downtrend. We've talked about it before, where it breaks a downtrend, breaks an uptrend. The first time it breaks it, and then normally it will carry on going up, but the second time it breaks that downtrend, say from this level, I think around the sort of 70 mark will be a time I believe that that the market will be going lower and it's about to enter a downtrend period. But again, you can clearly see that the same types of actions that go on in the American markets happen on the Australian market as well. This is the ASX 100 index, Australia's 100 largest companies grouped together into an index. You can see a huge triangle here where my mouse is, you know, starting from say 2010, draw a line all the way down, 2013, it's broken upwards out of that triangle, and if you draw a line along the top at 4,000, that's where I believe the next consolidation level will be. But whenever I say something like that, it's completely irrelevant, and you know, predicting, I'm always waiting for price action to guide me to what to do. You know, I can make a judgment, a guess that it may come back down to 4,000 at some point, but that's simply what it is. You know, I'll always rely on price action to tell me what to do, and the breaking of longer term trends as well. From here, I'm not too sure where the market's going to go in terms of the main index market. There are a few good looking stocks on the Australian market. I'll just wait and see how the price action develops here. It hasn't broken, say from this point, you draw a line up, you know, somewhere around the 3,900 level. It hasn't broken that trend, and it hasn't broken this trend as well, really. Perhaps maybe this little dip down here, but it hasn't really broken that uptrend. And usually when it breaks the first uptrend, you know, it will be what you call a feint, a dodge, and it will carry on going up from that. But that doesn't mean definitely it's going to happen. You know, always use price action as a guide. You know, don't try and anticipate too much or get too caught up in the fact that you've predicted something, say, to go to 4,000, and the price action is telling you something different a couple of weeks later. I mean, a lot of people can brainwash themselves like that. Amex Composite Index, XAX, and you can see here the huge rise up, and it had more of a pronounced bull market in 2003 compared to the bull market in other indices. They were much stronger in the 2009 bull market till now. This one hasn't had the same sort of significant huge move as it did in the previous bull market, but you can see it had the sharp shakeout and the turnaround at, you know, around the 2009 period. and it's moved up from there. It's broken the uptrend significantly here, and it seems to be in a consolidation phase here. And this is what you would call using a pivotal point. You use these pivotal points now that it's broken this uptrend for the first one, that the next time here it broke it, and this is why, you know, each high seems to be getting a little bit lower than the last high. If you look where my mouse is from here, the high, and it seems to be edging lower a little bit. But again, because it's in a consolidation area, I won't try and prejudge this index, and I'll wait to see what happens. But it does look to be a little bit of distribution here, but again, it hasn't had maybe what you would call the wild swings back in 2007 and 2008 at the back end here. But in comparison, with not that many speculators in the market in comparison to back then, sometimes you won't see the volatility spikes as much as you would in the past. And this is it on the weekly, and it looks a bit better here. If you draw a line along the top and you draw a line here, we could be forming some sort of breakout triangle, but as I said, on the monthly it looks to be going a little bit lower from here. I would use this, perhaps where my mouse is here is the 1 point, this pivotal point is the 2, and this is the 3, and if it breaks the 3 point, you know, I may sell it. And if it breaks the 2,500, the 1 point, I may go long. Again, these are the types of areas where it's not good to anticipate. Sometimes when a market's forming, like it is here, the action here, it looks very strong to me. Then it has a dip down, and then it goes up and dips down again. You've just got to be extremely careful of anticipating, and you just got to be patient and just wait for the market to show its hand. S&P 500 financial sector. You can see here where I draw my line at 220, it clearly broke the consolidation with this breakout here up to 240, and it's been in a uptrend ever since. And from the low in 2009, it's gone from 80 to 300. So it's a fairly decent sized percentage gain. And sometimes with these indices, you know, you won't see huge swings of volatility at the top because they operate on a different ratio to how stocks are traded. But you can see here the market low back in 2003, 2002, the extreme low was around 260, and most of the action support was around the 300 level. And this market has stopped at the 300 level. We're just going to have to wait and see what happens. But if you draw a line from 300 all the way back, Gann used to talk about if a market was in a significant long-term cyclical downtrend or uptrend and it had a move going the other way, sometimes the move the other way would bring it up to the level of the previous lows. So the market has bounced up. Perhaps it's at that level that Gann talked about now, and that will be the level roughly that we see it stay at for a little while, 300. And we'll have to wait for some price action to really see how this index is going to move from here. At the moment, I can't really tell with this limited price action here for 3 or 4 months. But again, you have seen a nice triangle breakout here. It's gone from 220 to 300. So perhaps there is a little juice left in this move, perhaps a bit more of a parabolic move up. But I think at some point it will stop at this buying area previously, somewhere between 320 and 260, and that will be the level that this market tops out at potentially. And again, I could change my mind that, based on price action. But it has had a very decent gain since 2009, and let's face it, I mean, nothing's really been fixed with the financial sector, has it? I mean, if you really get down to the nuts and bolts and the brass tacks of it, there are areas that have been changed and that have been beneficial, but you know, the fractional reserve banking system is still well in effect, and Also the leveraging of banks, either through subsidiaries or front companies, I'm sure is still highly prevalent. They just can't help themselves. Okay, this is the major market index, ticker XMI. Big companies in America. If my memory serves me correctly, it's the 20 largest companies listed in America. I believe like General Motors and other blue chip stocks all mixed together. So one would assume that when people panic or look for safety, they would move into these types of indices because of the blue chip nature of the companies involved. You can see here at the top of the previous cycle, the back end of 2007, you can see the long downtrend being broken, and you can see that the market is changing its technical position as that's happening. And this sort of area back in 2010, when it's breaking that trend, not the gradual, the very steep downtrend, you can see the action here is support action, and these are clues for the future as well. And you've got a nice triangle here as well, a longer term. If you look where my mouse is, all the way up to the 1500 area, then you draw a line down, a very nicely tight breakout action there, and the market sprang up from 1400 pretty much well, just over 1800 there. Again, not 100% sure from here. I mean, it looks to me like it's topping out. You know, from a chart perspective, it's had a decent rise up, considering their blue chip companies. This market went 1, 2 and a bit above, 1, 2, 3, 4 above the last high. It's been going up now for 1, 2, 3, 4, 5, just over well, around 5 years now. So it's had a pretty substantial bull market. If you look back to the bull market here, when it broke out in 1995, you had 1, 2, 3, 4, 5. You had 5 years exactly before the bull market completed its cycle. And I'm not saying we're going to have that again, but again, you must look at the time factor. Gann talked about it. A lot of the stuff Gann talked about was extremely confusing, but I understand the principle of time factor, and the time factor for a cycle to take place, or distribution to take place, or accumulation to take place. And that's quite often why I don't panic or I don't rush to buy, because I know there is a time cycle, a completion cycle that needs to take place. And it's the same here, you know, in terms of a bull market. You've had a 5-year cycle here. That's pretty damn good, and potentially, because these are you know, weird times that we're living through, we could see this go into the 6-year. Never dismiss something because something's never happened before or hasn't happened for a while. You can't use that as a guarantee that something will happen. You just got to be on the lookout for price action and the breaking of very long-term trends. And you know, if you look at this pivotal point here and you draw a line up to here and you keep drawing a line up, it still hasn't broken that longer-term uptrend where the move started. So I would say that once it broke that 1600, and then what we would probably see would be a bounce up and then some distribution like we saw here between 16 and 1700. That to me looked like good bit of distribution. Whoever's bought, well, whoever you know, wants to distribute, i.e. at this particular stage here and the market's being pushed up, whatever they've bought here in a small percentage can be sold perhaps when the market bounces here, with all the people going in, you know, for the correction rally. And that's quite often where they'll shift a lot, because there's a lot of, when the market's been going down a little while and it looks like it's going to correct, because in a bull market, when you have 5 or 6, say, shakeouts or 4 shakeouts, it trains people, like the Pavlov dog technique, that every time there's a correction they should pile right back in. And of course, you know, when that happens 4 or 5 times over the course of 5 years. It hypnotizes and brainwashes you that the next time there's going to be a correction, you should just steam right in there and buy. And that's where, you know, the guys that push the market up here will shift what they pushed up and perhaps shift it in this distribution area here. But you know, as I was saying, until it breaks some longer term uptrends, then I'm not looking to sell out a huge amount. I've sold bits and pieces with some stocks that have a little bit of wild volatility, but in terms of shorting an index, you know, if you draw a line up from here to the end of 2011, you draw a line up from here. Once it breaks that, that's usually a sign that it will have another spike back up, just simply because of, you know, tricking trend following computers. You know, when it breaks a 3 or 4 year trend, a lot of computer generated trading computers will short the market. It's a great way to you know, to distribute some of your holdings, or to manipulate in terms of what they do. And when the market goes back up, you know, they'll sell out their positions and perhaps give it a spike. And it's just really playing around with algorithms these days as well. Not only is it about you know, hoodwinking the public, so to speak, as it was purely really back in 1929. You got to hoodwink a lot of computers as well now, and it's an exceedingly profitable business, because there are a lot of people that program their algorithms in a very stupid fashion, and a lot of people that have been involved in that type of business, you know, they think they're onto a winner, but after 6 months or a year, whether it's through nefarious activities or through watching the actual trades or analysing them through another computer, people will catch on at some point to how you're trading. And whether, as I said, that sometimes, a lot of the times, is through nefarious activities as well. That's just a simple explanation of the major market index in case anyone that's interested. S&P 500 consumer discretionary had a huge rise up. I just flicked off that. Let me just go back. You can see it's gone from 140 up to 520. The good old American consumer is keeping their end of the bargain and keeping on spending, really. And you can see the tight triangle. If you look at where my mouse is here, you draw a line up to the top and you draw a line down there. Fantastic breakout triangle at 380, and then a huge move upwards. And then personally, you know, it would be probably a little bit quick maybe to sell this index, but because of the parabolic move from 460 to 520, I went flat the market on the index positions, quite simply because sometimes I'll do that. You know, I will anticipate, you know, because I'm human. I may well be wrong, and it may push back up to 520 again, but I believe here this is where we'll see the distribution area in the S&P 500 consumer discretionary index between, say, 520 and 480. To me, this looks like a market that's topping out. Again, I may be too soon making that judgment, and that's why also that brings me back to Jesse Livermore and why I put it on the front slide. You know, his mentality in 1929. He was shorting, I believe it was the auto stocks, and they started rolling over and he started making money, so he thought it was safe to short all the other markets. And if you've read Reminiscences of a Stock Market Operator or looked into his trading life, you'll know that he shorted the market a few months too soon, and he nearly bankrupted himself. By October 1929 had come around, he was pretty much leveraged to the hilt and on the verge of bankruptcy again. And if the market hadn't have gone down that month, perhaps just another 2 or 3 weeks into November, it would have bankrupted him, and he would have never have made $100 million from shorting the market. So sometimes, you know, timing is very important, but just because, you know, one industry, the consumer discretionary industry, looks like, to me, like it's topping out, it doesn't mean necessarily the whole market's topping out. there are some indices that do look like they're topping out, and there's other ones that perhaps look like they've got some legs in them, and that may justify the theory of just one more move up in the Dow. Or, you know, even if it's not a sort of another leg up in the bull market, even if it's a move up back to where the old highs were a couple of weeks ago, that sometimes can be enough to give stocks that are listed or in the process of moving up, that can be enough to give them a huge boost, you know, whilst the distribution process is taking place, because the downtrend hasn't begun. So people are still confident in some way about stocks, and you still can distribute some companies that are laggards, you know, later on in a bull market. Not every stock rolls over, or every industry sector rolls over together, so just bear that in mind. The S&P 500 information technology sector, the index for that, and you can see here, I mean, it's very similar actually chart pattern to the Nasdaq chart pattern, and you can see, you know, drawing a line from the top here down, you can see the technical position going from weak to strong as it breaks up out of that downtrend that it was in, consolidating the next level of consolidation. You draw a line along the top, it breaks out. You draw a line along here and you've got a flat top triangle from say 450 up to 500, and then from here, say at 520, all the way back to here. It's a long-term flat top triangle. Sometimes when these do break out, which it did beautifully, you will get a shakeout, sometimes back to the top level of where the consolidation was, say around the 500. But this looks to me, you know, good to go, I reckon, to perhaps 600, 650. I think it's got the legs, just simply because of the shape of the market in terms of its trajectory. And if you look here, what I mean, you'll see that if you draw a line from here all the way up, in no way have we reached the what you would call the parabolic stage, where the trend becomes very steep and pronounced. The trend here is still quite gradual on the upside. You know, whenever a market tops out, I'm not saying that this is an absolutely golden law, because I once saw, was it NIA, the bond insurer, back in 2007, I saw that top out with almost a flat line without the parabolic move or even a steep uptrend. It just collapsed. But you see here, the market hasn't become steep, and you know, looking back at previous positions over a number of years, topping out takes place when the market is at the top of an uptrend, and I don't believe this market is topping out, and I think it will go higher, perhaps to 600 to 650. But again, I'll wait and see how the price action develops at this consolidation period here. S&P 500 energy index, and again you can see the great formations back in the beginning of the bull market, the commodity bull market in 2003, 2004. You know, a great base action area as it breaks out, and a fantastic move up over the years. And you can clearly see the wild swings and distributions in this market. It's probably reflected because of how wild the crude oil price was back then. I mean, we'd gone from a period of a decade with, you know, $5 to $6 moves over a year to a period of months, you know, back in 2007, where the market was moving, you know, 15, 20 bucks a week in crude oil. And yeah, I remember, you know, back then I shorted the market. I think it was about 3 days early, and it was right at the peak, and I got hammered on some futures positions because I'd gone in 3 days early, and the market had been in that process of parabolic spiking, and it was tough to hold on. But luckily, you know, it was only 3 days where the market, and it absolutely collapsed from there. So I was very lucky in that respect, and that was part of the process of learning. Just because something's wildly overvalued and it's swinging wildly, it doesn't mean that you should automatically short it. It's just simply sometimes you get a feeling for a market if you are watching it closely, and I don't doubt there's a lot of people that have got a very good sense, tape reading, watching the market and the ticks, and it can be done, but I don't think mentally it's good for you, and lasting in that type of business, you won't last long. And this is it on the weekly. You can see that the triangle has been formed here somewhat, and you can see a clear breakout from the triangle and the market moving gradually up. And you can see, if you draw a line up, that this move here has broken that uptrend. Now from here it's trying to figure out whether is this a fake shakeout, so to speak, and is it one of those where there's always a move that breaks the trend just to trick the trend followers, and I believe there's a high probability that it is. I've had a look at the crude oil chart. I mean, I do think longer term that crude oil will come down, but sometimes price action and where the market is, you have to slightly change your opinion depending on how the market's shaping up. But I won't change my opinion unless we see a breakout above the, say, 645, 650 figure here. But you can clearly see that it's a longer term triangle, and it has broken up, and we haven't really seen a pronounced uptrend or a parabolic uptrend. But this does look quite promising for the future. But in terms of the future, I mean, the next 3 to 6 months. But in terms of actually taking a position, I wouldn't do that. As I say, I'm just here to watch and to train myself, not to anticipate. I need the market to show me its hand. I can have a feeling about something, and I can be pretty sure that something's going to happen, but that just doesn't mean that it is. And that's why it's very, very important as a trader for longevity, if you want to survive in this business, to try not to anticipate too much. S&P GSCI, I believe that stands for the Goldman Sachs Commodity Index. You can see here the triangle that's been forming. Is this a distribution? Excuse me. Is this a distribution triangle? I'm just not 100% sure. It kind of looks like that, like I said on the crude oil the other week. But again, there are some commodities that do have some shaping up patterns that look quite nice at the moment. But sometimes when the market has behaved and had huge run-ups, you will get these types of patterns. But if this market breaks out on the upside, I will look to go long, and then I'll be very careful in case it's a false move, because I have seen this where you've got these types of longer patterns, and each preceding high is lower than the last high. So you've got 1, 2, 3, 4, 5, perhaps the next one's 6, and each one is almost lower than the last one. So it is forming a distribution triangle. If this was more positive on the upside, we would see, where my mouse is here, we would see this action perhaps placed around the 700 and developing into some sort of breakout, breaking the downtrend. So again, if it does break this downtrend here, which is quite gradual, I will take a position, but I will be very, very cautious for it to be a fake move and for that move to come back down. And if it breaks 600, I'll short the market on the downside, and if it breaks 550 again, I'll short the market. But this is a good place to educate yourself on pivotal points and the importance of not anticipating, waiting for the market to show its hand. Sometimes even when it does show its hand, as I said about the false moves and the shakeouts, it will put you in the wrong position. But right after that happens, the market becomes so clear, and there's a lot of clarity to what you need to do, simply because of the simple ethos of following long-term trends and the breaking of them. And you can clearly see here that this long-term trend has been broken. It went down, then it went up again, and it looks to have come back down here. And to me, this looks to be like, as I said, a distribution triangle, but I cannot be 100% positive, and I need to wait for clarification, via price action for that. But look at this spike back in 2007 and 2008, the commodity spike. You know, whenever you see a market do that, it's just never going to last. Whenever you hear people saying it's different this time, I remember helping a friend pen an article about Iker Batista in Brazil and his Superport, and The Guardian, which is an English newspaper. Americans are probably familiar with those for releasing the Snowden details. But they were talking about how the new superhighway between China and Brazil, the shipping of grains, you know, it was a totally new paradigm. And in some ways, you know, over the long term, you know, if the world comes together, it is in a way. But, you know, whenever you hear something combined with a price spike and a parabolic move like we saw back in 2007 and 2008, it's a real mugs game. You know, I mean, you've really got to learn that first about trading. You know, in terms of watching bubbles and really detaching yourself. And that's why if you focus too much and you watch Bloomberg TV and you read too many newspapers and you talk with too many traders, you're going to find it very hard to make your own decisions. You may think you are, but at the critical moments, you won't realize how well you've been conditioned. You know, a lot of it's subconscious, and that's where you must have your absolute rules and try to not anticipate moves in the market. Okay, this is it on the 5-year weekly, and this is why I said, you know, it was kind of looking almost like a breakout triangle, but the reason, you know, as I was saying before, these lower highs here and this market here, if it did break some moves, as I said, on say this sideways move here just below 650, if it broke that, we could see a move up, and as I said, I'd go long the market for more of a short-term trade, and I'd follow the market up till it broke the trend, whether it ended up round about 700, 750, or if it was just a false move up to 650, 670 or 680. Once it had broken that trend, I would sell out, and as I say, I'm, you know, weighing towards the side of this market going down a bit further. But who knows what Yellen surprises are for the market tomorrow. And you know, commodities could go up for 2 or 3 months, but that doesn't mean longer term that they're going to go up. You've just got to wait for the price action and see how that develops. The Russell 3000, I like the Russell 3000 because it's a great coverage of American companies. And you can see here the market's been in a, you know, a rip-roaring bull market here. You've had 1, 2, 3, 4, 5, just over 5 years. And back here, 1, 2, 3, 4, 5, 6 is where the distribution took place. And this market here was roughly 1, 2, 3, 4, 5. You're approaching the final stages. You're in the 5th year of a bull market. In the history of this market, the 5th or the 6th year is a signal. I mean, really back in the early 90s was what some people call the pinnacle of where America reached in terms of its, you know, power around the world and its control. And it was a huge bull market, that 90s bull market, fueled by low Greenspan interest rates in comparison to Bernanke's interest rates. Obviously they're not that low. They would kill the market these days if they had those interest rates. But this bull market was interesting, you know, from the early 90s, simply because it combined with a dollar rally. So the US dollar rallied with this bull market here from say 94 to, I think it was 98, 2000, but anyway, they followed each other, and this is what I mean about not getting too conditioned and caught up, and making sure you're not susceptible to the Pavlov dog syndrome by saying that if the US dollar goes down, the market will go up. Things change, just like the Chinese yuan. You know, it's not going to gain against the American dollar forever, that's for sure. But according to some people in the last 2 years, you know, it's a one-way trade. And of course it is in the last 2 years, but things change. You know, the winds don't always blow in the same direction forever. And we talked about it last week, to always try and expect the unexpected. A great breakout triangle here in 2011, like we've seen on a lot of index charts, and a good spike up and a good move upwards. And the bull market here, and pretty much here as well. This market was combined really, especially this cycle from 2003 to 2008 was combined with a falling dollar. So you've got a completely opposite scenario. This bull market here, a rising dollar, this bull market, a falling dollar. So just bear that in mind. You know, I was going long a hell of a lot of Japanese stocks a couple of years ago because there was tremendous flat lines in Japan, and lo and behold, with the currency debasement going on in Japan at the moment, stocks have shot up. But a lot of my gains in Japan have been offset, say, with currency losses when I move out of the yen. So you've got to factor all that in as well when you're moving money around the world and trading in different currencies. But generally, investors think these days that if the market goes up, the currency goes down. But paradigms, do change. You know, things don't stay that way forever, and don't get caught into the trap of thinking that. For example, we could see the US dollar go up, and we could see commodities go up as well. Why not? You know, it's always something you've got to be on the lookout for. Always expect the unexpected, and just be on the watch out for price action to give you that clue. And here's the US dollar index, and I just wanted to put that up there just to show you the long-term trends being broken. We can just follow the market as we've been doing on previous Oak Trader reports. And this is what I was talking about in terms of the opposite to perhaps the distribution triangle I showed you before in the Goldman Sachs Commodity Index. This action here, where my mouse is taking place at a much higher level compared to the Goldman Sachs triangle that we looked at previously. That's taking place at a low level down here. Now, as I said before, no rule is golden and no rule is final, but in terms of what's happened previously, that is quite a good sign. And we've just had a trend being broken, the uptrends being broken. That would have shaken out a few people from the market. If the market here, where I draw my line here and here, can break above that, I would be very positive we'd see a US dollar rally against a whole host of different currencies. We've already seen the Turkish lira, get battered this year and last year, and other currencies as well taking a beating, like the Indian rupiah against the US dollar. And I'm very bullish the US dollar to gain against the Canadian dollar. The Canadian dollar, I believe, will have some problems over the next 6 months to a year. There's a lot of housing bubbles around the world. In places like Norway, there's a housing bubble which I believe will crash soon. And when it does crash, and when I say crash, I mean it could just be a very decent sized correction. And I believe it will be a good time to go into Norway and to buy up assets in Norway. And it's the same with Canada. I'm waiting for there to be some more value in the Canadian market. They've had a good run up in house prices, and we could see that in Canada, Norway, Sydney, London, those types of places. We could see quite large corrections in property prices at some point in the next 6 months to a year. And I think a lot of the inflation is going towards those types of properties, especially in places like London, and previously Oslo as well, and other locations in Canada. I mean, you look at, say for example, farmland in America. There has been a lot of inflation in America, it just hasn't been publicized. And you look at a lot of commodities in comparison to where they were 10, 13 years ago, they're still extremely high to where they were. And they probably deserve to be that high because of the prices farmers have had to suffer during the lean periods of the late 80s and 90s. It was a tough period to be a farmer and to receive such low prices for commodities. But times do change, and I'm not sure exactly what's going to happen with the US dollar. As I said, I'm waiting for these downtrends to be broken, but again, I'm always on the lookout as well that if Yellen came out and really pleased the market and everything rallied in commodities and the stocks rallied and the US dollar index came down to 75, I never leverage myself or anticipate that much where it's going to hurt me. You've got to be patient in these long-term plays, but when this does break out finally, it will be quite a longer term trade, and it will be a very good ride, I believe. But during this base action, you know, we could see another triple bottom down, but I have the feeling, just from experience or whatever it is, I have the feeling that this market is going to go much, much higher in the next 6 months to a year. And I think that's only valid, of course, you know, once these trends have been broken and this downtrend here is finally broken. Once we can see it come above 85, put its head above the parapet, show me true technical strength, you know, in terms of the market moving from a downwards to sideways gradual downward pattern. And if it did break above the 85, it would prove to me that there was technical strength, you know, with a little bit more conviction, and that would force me to go long the US dollar against a whole host of different currencies. Okay, I just thought I'd put the uranium price up there. I've seen a few people going on about it, talking about, you know, how great it is and how fantastic. You can see the long-term downtrend being broken, the 2009 recession, the little bit of a bounce, and then with Fukushima, the crash, so to speak, and then the downtrend, and you can see it here almost settling. The time to go long uranium is the time when this downtrend is broken, and it's not yet. The downtrend, if you draw a line from here, I know everyone laughs at my trend lines, but I'm just that type of person. I'm not interested. I do love seeing neatly drawn trend lines, but people do them at home or can imagine the trend line themselves, you know. But you see it here and here. You can see that it hasn't broken that downtrend, and when it does, it will probably form some sort of head and shoulders here. But this is definitely one to watch for a potential rise in the future. Sometime in around 6 months to a year, an uptrend could develop in uranium, and we could see the market move to 40 to 45 and develop a nice shoulder here. You've got the shoulder here, the head. Is it going to break up to 40, 45, 50 and form a shoulder and consolidate? Perhaps, and then it would start its uptrend. Personally, you know, I'm not in favour of nuclear power. I just can't see the common sense in trying to store something for 1,000 years safely. It just can't be done. You know, it's all very well burying it 10,000 meters below the ground. There's still so much scientists don't understand about the crust of the earth. You know, even if there's a minuscule chance of a meteorite hitting that area, you know, this isn't American football or English football where you take a chance on a play, you know, go for it. You know, he who dares wins. You know, this is nuclear power we're talking about here. You know, stuffing at 10,000 meters underground is just not a very good idea, even if there's a 0.001% probability of a meteorite hitting, or as I say, you know, underground movement. It's just not worth the chance. And I think Germany is a country to be much admired with its foresight for the future, and I wish them all the best on their goal of going alternative. I'm not necessarily saying solar's the right way, wind's the right way, whatever way it can be done, but without uranium. You know, I'd much prefer to have more fracking and natural gas than uranium, but in terms of making a buck, I will participate and speculate and invest in uranium, but I'll also, you know, get my point out there as well. Hopefully one day the market for uranium will disappear, but until then I don't see that on the horizon. There's still so many what I would call pig-headed countries out there that, you know, if you look at it, they're just intent on moving in one direction, when, you know, the leaders of the world at the moment, you know, in terms of foresight, and I have to say that, you know, is the Germans. You know, in terms of the last 10, 15 years, they're the country, you know, for what they've done, um, in terms of the trends that they've set. I believe other countries should be following them. And it's quite a controversial opinion, but I think a lot of these countries in Africa, Central America, South America, you know, could do themselves a lot of favours by installing people from successful countries to run their economies, to take finance positions. You know, once that person had reached a certain stage in business, he may feel like that for 3 or 4 years, to go to a country like Venezuela or Argentina, or Uganda or Kenya, and just sort out the mess. You know, it's been long enough in terms of what they've tried to do with their economies. And sometimes it's like a business or a football team. You put a man in charge who's the best to do the job. And it's like the English football team. We've had an Italian in charge, a Swede in charge. You know, and that's one great thing about England. We're not afraid to give the job to the best person possible. And I think a lot of these countries that are just in a complete mess all the time could learn something from, you know, that ethos, about bringing in successful people, you know, to run areas of their economy, because they're just proving that they can't do it themselves. And this brings me on to the subject, why I've brought it up anyway, because I've been getting a lot of emails, you know, where would you put your money in Africa? Where would you put your money in Central America, Asia? And of course, I always recommend, you know, for anyone with limited funds, you know, don't step outside of New Zealand, Canada, Australia, America, Ireland, the UK, because it's what you know. You know, once you've got over a certain amount of funds, yeah, sure, go out, you know, invest in emerging markets, you know, look to take some of that discretionary capital and speculate with it in these wild markets. But from 22 odd years experience of being around, you know, a lot of different markets around the world, and I have friends that invest all over the world, and a lot of the time I sit back and listen to their stories, and in terms of, you know, how much hassle it brings their life, you know, and a lot of them regret doing it. Of course, I'm not talking about big conglomerates here. They're going to go into all the markets they can possibly can because they don't care, but I'm talking about your PT, your perpetual traveller, your previous taxpayer, perpetual tourist, you know, guys that travel around the world looking for investments and what to do. If you haven't got a huge amount of funds, you know, stick in those countries that I mentioned. Add Norway to that, Sweden, Denmark. You know, these are places where they don't change the goalposts. You invest, and a couple of weeks later the laws are still the same. Whereas in a lot of these countries in Africa, you've really got to be sharp to keep up to date with what's going on. But with all that said, you know, if you've got a lot of discretionary capital and you're looking for a lot of adventure and also a lot of fun, but it can be a lot of hassle as well, then I would look at Tanzania as a good place. You know, it's got everything, the country, you know, it's fantastic people, it's got the scenery, it's got the beaches, the capital city, Dar es Salaam, is a great place as well. There's a lot of Indian expatriates that have done business in the country as well, and still do business in the country, kicked out by Idi Amin in Uganda. Kenya, you know, great people, great country, great scenery, but I just prefer Tanzania on the east coast. That's my favourite country on the east coast, and it's also the country I think that's got the most potential for investments. Of course, you look down here and you've got a little island called Mauritius. A lot of Indian businessmen use this locale as a place to do business all around the world, and also business within India. It's an offshore tax haven, Mauritius. It's a nice island to visit. It's, you know, it's not somewhere where I would keep a lot of money, and also, you know, there's still a lot of different areas on the island that perhaps you would consider dangerous, but it's an absolutely stunning place, and it's very safe for a couple of week holiday. I mean, I'd compare it to, say, it's the Jamaica of the Indian Ocean, but it's even more beautiful, I would say, than perhaps Jamaica in terms of its financial services it offers. South Africa, great country. Cape Town is one of the world's most beautiful cities. It's got one of the most temperate climates as well. I think it's 20 degrees or 21 degrees year round. There's a higher female proportion of residents in Cape Town, so it's got everything really. I've never been over to Durban, but South Africa is a great country, but again it's got huge problems, and it's got a huge populace that is one step away from worshipping Fidel Castro. So that's a huge worry about South Africa. Great country, it's got everything, and this goes back to my point, about stop mucking around. The country could be so magnificent, South Africa. They really need to get the house in order there and sort out everything, because there's a whole chunk of capital waiting to be invested there, but people are just too scared. As I said before, when you study history and you see what happens to countries like Cuba, Venezuela, Argentina, it's not beyond the pale to think that is the next step in South Africa. Namibia, again, potentially you could stash a bit of money there. It's got good parts. The Skeleton Coast, absolutely stunning country. Namibia, South Africa and Botswana, are all three good countries there. That region of Africa really could develop into a powerhouse. It's got everything, but whether the people have the foresight and the common sense to come together is another issue. And then you've got Angola here, huge oil reserves and very beautiful women, but the business there, I wouldn't even really touch it with a barge pole. There's just too many people that want something for nothing there, well overpriced. Everything that's imported is just so expensive, and Angola's got a very turbulent past as well. Cuba was in there, Russia was in there. There was a big civil war, and there was a lot of mercenaries that came from England. It's just one of those countries again, that because of its oil wealth, it's great, but it also makes it vulnerable as well, because that's it really. Without that, if they don't get their house in order soon, and we do see a fall in the crude oil price, they'll be in a lot of trouble, and it's not a country I'd want to be in if there was a lot of trouble. And then all along the west coast here, Gambia's a fantastic country to visit. Senegal as well. The Cape Verde Islands are nice. More as a tourist, there's not really great investment opportunities in any of those countries. Gambia, a little bit of tourism. Liberia, you should check out. There's a program on Vice that talks about the civil war on there. I believe the country was founded by American slaves going back to Africa, and it was affiliated with America, and it should be the Hong Kong of Africa really. But I just don't know what happened, why the Americans didn't carry on with their support, why they didn't try and push things more, why did they let it fall apart. That was one of the mistakes, I believe, of the American administration, allowing Liberia to fall apart. That country could, and it still could be, but it's very doubtful now. It's almost a failed state, but it's got the potential. It did have the potential to be the Hong Kong of West Africa. And then Ghana as well is another country. It's met some fantastic people from Ghana, very friendly, great tourist destination, and not a bad place to do business. They're improving, and the people there are not one step away from Fidel Castro. I think they're quite, democratic. There's a reality there that if they want to get on, that they're going to have to do stuff, and Ghana's a good country for that. And then up here, Morocco, great country, fantastic culture, cuisine. The women are really pretty. It's got everything. There is a little bit of an underbelly of rebellion. Perhaps 15-20% of the population is not that keen on the monarchy, but it's got a very devout following, the monarchy there. And just up here as well, they named the hashish they produced after, I think is it King Hussein? I'm not sure the king of Morocco, but they named the hashish after him. So it's quite a wild country, and it's got some amazing scenery as well, and beaches. And wherever you go, I mean, you get approached by salesmen. That's one of the problems with Morocco. It's you just can't find a moment's peace. But you know, if you're someone that you know, doesn't mind interacting with people, it's a great place to meet the locals. They all play football on the beach. Very, very friendly. I've never seen such hospitality. Morocco was one of the first countries I visited where they really showed me what hospitality was about. You know, very, very friendly people, and very kind as well. And over here, Ethiopia, I forgot to mention. Well, there's so many countries I forgot to mention, but Ethiopia, another great country with culture, and even the cuisine's nice as well. The people are very friendly, and it's got a lot of opportunities. But you know, there's a lot of silly rules in these countries. Just like in the DRC here, a couple of friends from London, from the Democratic Republic of Congo. You know, there's a lot of people that want to do business in this country, but just because of what's going on in Goma, and the UN presence in the country as well, and it just stops people investing, and they really need to get everything sorted out. And you got Sudan here, where you've got the Chinese, and then you've got South Sudan, where you've got the British and the Americans. So there's potential flashpoints all over Africa, and then you've got the French over here as well. I just hope it gets better, and you know, people see some sense, because I know it's not all problems. A lot of it's been caused from the outside. You know, people pulling puppet strings here and there. But again, things can be done to sort out their own country, and that must happen in the next 5 or 6 years. But hopefully those countries I've mentioned, you know, you could look at those countries and you'd have a lot of fun in them. You know, I'd stay away from Egypt, Liberia, and Algeria. Tunisia's okay as a little tourism spot just off Malta. Egypt's a great country to visit, but it just, compare it to Morocco, I just don't feel that the friendliness there that perhaps was once there. The friendliness has gone for me in the last 10 years. I mean, Morocco stands out in the region, but it has got some great attractions, Egypt, and it's definitely worth checking out one day, but not as an investment destination. Yeah, Asia here. What I'm going to do is I'll go on to this on the second part, because I just can't help it. Every time I see a country, I've just got so much, you know, to either talk about or to mention, and there's so many of them. I'll just show you here North America as well, South America, Europe, and the Middle East, and Oceania. And these are the questions that I've got coming in. You know, where would you do this, where would you do that? I'm no expert, I'm just an ordinary guy that's been to a lot of countries and experienced a lot of things, and you know, I'll do my best to point out what I feel about the country in a completely forthright fashion. So hopefully it hasn't offended anyone, but what I'll do is put this up on a part 2, because I believe it's coming up to about 5:30 in the morning. I've been up for about 20 hours now. My brain is just mullered, and it's time to sign off. And what I'll do, as soon as I wake up tomorrow, I'll put part 2 up as well. And there's some more companies in the IT services sector in America that I'm taking a look at as well, and I'll do a screencast of that. Okay, over and out, and I'll speak to you soon. Bye for now.